What if I told you that India's newest investment vehicle, just months old, is already attracting thousands of crores from investors? We're talking about Specialized Investment Funds or SIFs, introduced by SEBI in April 2025. Let's explore the top 10 reasons why India's smartest investors are moving to SIFs, backed by real data, examples, and insights from trusted sources. So, reason number one, backed by SEBI. The SIF framework became effective on April 1st of 2025. Under SEBI's new guidelines, it came to bridge mutual funds and PMS. These are fully SEBI regulated with all investor protections in place. Example, Quant Mutual Fund launched India's first SIF, the Quant Equity Long Short Fund, on September 17th, followed by Edelweiss Altiva Hybrid Long Short on October 1st. So these funds are already in place and many more SIFs are going to be launched in the near months. Reason number two, affordable entry point. So what is the minimum amount you need to invest in SIFs? It is 10 lakh rupees. Unlike a PMS or AIF where you need 50 lakhs or 1 crore respectively, SIFs start at just 10 lakhs. According to MFI data of June 25, India already has 8 lakh mutual fund investors with portfolios above 10 lakhs. Exactly the audience SIFs are built for. In fact, SIFs are built for people or investors who are in the markets for 8 to 10 years or have a corpus of above 75 lakhs or 1 crore. It's literally the next level for India's affluent mutual fund investors. Reason number three, strategy freedom beyond mutual funds. See, mutual funds are limited to long-only strategies. But SIFs, however, can use long-short equity, arbitrage, multi-asset or hybrid models, allowing fund managers to capture both up and down markets. Let's take an example. See, the Quant SIF follows a long-short structure. What does it mean? It means it can profit in both rising and falling markets. It actually reduces your beta, and these products are also known as beta-adjusted products. Reason number four, better risk management. Because of that flexibility, SIF shows lower volatility. Let's take some data. As per NSE Data Lab 2024, long-short equity indices show 20 to 30% lower volatility than Nifty 50. So what does this do? This actually helps investors smoothen out the market shocks while still compounding wealth and adding another layer or another dimension to their portfolio. Reason number five, the hidden tax edge. So what happens in FDs? In FDs, your interest is taxed annually irrespective of whether you take out the money or not, even if you do not redeem, and they are taxed at your slab rate. But with SIFs, what happens? In SIFs, taxes are deferred until redemption, meaning your money compounds uninterrupted, and also you get the benefit of equity taxation. So your money compounds uninterrupted. So let's take a simulation done by Morningstar India in 2025. What did they find? They found that tax deferral itself can improve your long-term returns by how much? About 2% CAGR over 10 years. That's like getting an extra year of growth without any extra risk. Reason number six, institutional grade management. So SIFs are run by the same portfolio teams who manage sophisticated instruments like PMS and AIFs, which are available to institutions earlier. Same strategies are accessible to mutual fund investors starting at just a threshold of 10 lakhs. So Edelweiss Altiva SIF is co-managed by fund managers who were actually overseeing their AIF funds also. Reason number seven, diversification. Diversification power. You can blend a composition of equity, debt, arbitrage, derivatives, and even global exposure within one fund. See, according to SEBI's SIF filings, over 70% of SIFs which are getting launched are hybrid in nature or multi-asset in nature. So they are designed to balance growth along with stability and lower volatility. Reason number eight, liquidity and access. So unlike AIFs, most SIFs allow quarterly or semi-annual redemption, offering more liquidity. For example, Edelweiss Altiva allows redemption every quarter, a major plus for investors who don't want a long lock-in. Reason number nine, market beating potential. According to NSE back-tested models of 2024, long-short equity portfolios delivered 12 to 13% annualized returns with lower drawdowns than Nifty 50. What does this mean? You get a portfolio which is better risk adjusted than a normal equity only portfolio. That means smoother performance in volatile markets, exactly what investors are craving for. And reason number 10, early mover advantage. Remember, when mutual funds were the niche in early 2000s, the first investors got the biggest edge. We are at the same stage now with SIFs. Analysts are projecting the SIF industry could reach how much? 2 lakh crores AUM by 2030, driven by HNIs seeking tax-efficient, flexible options. So in conclusion, what I would like to say is that SIFs combine flexibility, tax efficiency, diversification, and institutional expertise all under SEBI's watch. They aren't replacing mutual funds, they are enhancing portfolios for India's next generation of serious investors. Follow Enrichwise for more SIF insights, strategy breakdowns, and real-world investment analysis. Thank you so much.